In 2021, a man in San Francisco forgot the password to a hard drive containing $220 million in Bitcoin. He gets 10 attempts before the drive erases itself forever. He's used 8. That's not a cautionary tale about passwords, it's a perfect encapsulation of what cryptocurrency actually is. An asset so volatile, so technically unforgiving, and so psychologically destabilizing that forgetting a string of characters can mean the difference between generational wealth and nothing at all. And yet, right now, in 2026, after multiple crashes, regulatory crackdowns, and thousands of failed coins, Americans are pouring money into crypto at rates that rival the 2021 peak. The difference is they think they're being smarter this time. They're probably not. Here's why this matters now, and why it's different than it was 5 years ago. The United States government has shifted its stance. Not dramatically, but enough. Bitcoin ETFs are now traded on major exchanges. Coinbase is still standing. Certain politicians openly hold crypto. The thing that was once dismissed as libertarian fantasy money has become something you can buy through your retirement account. This legitimacy is dangerous in a specific way. It makes people think the risk has been regulated away. It hasn't. What's changed is the infrastructure. What hasn't changed is the fundamental nature of the asset. Permissionless, borderless, and completely indifferent to whether you understand it. So let's say you're a beginner. You have some savings. You've heard Bitcoin described as digital gold and Ethereum as the internet of money. And both of those phrases sound compelling, but also completely meaningless. You want in, but you don't want to be the person who buys at the top, or worse, the person who loses everything to a scam so obvious in hindsight that your family stops taking your financial advice seriously. Fair concern. Let's start with what crypto actually is, stripped of the mythology. A cryptocurrency is a digital ledger entry. When you own Bitcoin, you don't own a physical thing. You own the cryptographic proof that a specific amount of value is associated with your digital wallet. That proof is maintained by a global network of computers that all agree through a process called consensus on who owns what. No bank, no intermediary, just code and electricity. This is appealing for obvious reasons. It's also terrifying for the same reasons. There are over 20,000 cryptocurrencies in existence. Most are worth nothing. Many were designed to be worth nothing. The gap between a legitimate project and a sophisticated scam is often just marketing budget and timing. So what should a beginner actually consider buying? Bitcoin, Ethereum, maybe a handful of others if you've done real research. And by research, I mean reading white papers and understanding use cases, not watching YouTube hype videos or following someone with laser eyes in their profile picture. Bitcoin is the oldest, the most liquid, and the most philosophically coherent. It was designed as a decentralized store of value. It does one thing. It doesn't promise to cure cancer or replace the internet. That simplicity is a feature. Ethereum is more complex. It's a platform for decentralized applications. Smart contracts run on it, NFTs were built on it. Whether those use cases justify the price is an open and contentious question, but Ethereum has developers, infrastructure, and adoption. That matters. Everything else exists on a spectrum between interesting technology with uncertain future and exit scam waiting to happen.
Now, let's talk about how much to invest, and this is where the conversation gets uncomfortable. The standard financial advice is that you shouldn't invest more than you can afford to lose. With crypto, that advice isn't dramatic, it's literal. There is a non-zero chance that whatever you buy goes to zero. Not unlikely, not unthinkable, non-zero. In 2022, Luna, a top 10 cryptocurrency by market cap, collapsed from $116 to functionally worthless in 48 hours. Billions evaporated. People lost their savings. Some lost more than their savings. They lost borrowed money. That's not ancient history. That's 2 boom and bust cycles ago. So here's a framework. If you're a beginner in the US with no crypto exposure and you want some, a reasonable allocation is somewhere between 1 and 5% of your investable assets. Not your net worth, not your emergency fund, your risk capital. If Bitcoin goes to zero, your life doesn't change. If it goes to $200,000, you participate in the upside modestly. You're not getting rich, but you're not getting destroyed either. The people who got rich from crypto were early, lucky, or both. The people getting in now are doing something different. They're speculating on an asset class that has already had multiple global news cycles, regulatory attention, and mass adoption attempts. That doesn't mean there's no upside left. It means the easy money, if it ever existed, is gone. Let's contrast what you'll hear versus what's actually true. You'll hear, Bitcoin is a hedge against inflation. What's true, Bitcoin's price has almost no correlation with inflation. It trades like a tech stock. When risk appetite is high, it goes up. When fear dominates, it crashes. In 2022, during one of the highest inflation periods in decades, Bitcoin lost more than 60% of its value. You'll hear, blockchain will revolutionize everything. What's true, blockchain is a useful technology for specific problems, mostly involving trustless verification. Most things do not need trustless verification. Most industries that claim they'll be disrupted by blockchain are not being disrupted, they're just adding crypto to a pitch deck. You'll hear, this coin is going to 100x. No one knows. The people telling you this are either trying to sell you something or convincing themselves they made a mistake. Price predictions in crypto are astrology for people with Bloomberg terminals. The reality is that crypto is an emerging asset class with genuine technological innovation underneath it, wrapped in layers of speculation, fraud, tribalism, and absurd wealth disparities. Both things are true. The innovation is real, the circus is also real. Here's what to avoid, in order of severity. Anything promising guaranteed returns. If someone is guaranteeing you 20% a year in crypto, you're looking at a Ponzi scheme. The regulation might be light, but the physics of finance still apply. Coins with no clear use case that are being shilled by influencers. If the only argument for buying something is that the price will go up, you're not investing. You're gambling on collective delusion. Leverage. Crypto is volatile enough. Borrowing money to multiply that volatility is not bold, it's statistically reckless. Platforms you don't understand. If you can't explain how your crypto is being stored, secured, or accessed, you're one security flaw away from losing it. And finally, avoid FOMO. The fear of missing out has ruined more portfolios than market crashes. There is no such thing as the last chance to get in. Crypto has had 14 last chances since 2017. Zoom out for a second. We're living through a weird moment in financial history. Traditional assets feel expensive. Savings accounts barely beat inflation. Real estate is out of reach for millions. And here comes this alternative, this digital frontier that promises autonomy, upside, and a little bit of rebellion. It makes sense that people are drawn to it. But the question isn't whether crypto is legitimate. Parts of it clearly are. The question is whether you, specifically, with your goals, your timeline, and your risk tolerance, should own it. And if so, how much? Most people overestimate their risk tolerance until the first 40% drawdown. Then they panic sell, then they watch it recover without them, then they buy back in at a higher price. This cycle has played out so many times it has its own terminology. So here's where we land. If you're a beginner in the US and you want to own crypto, buy Bitcoin or Ethereum through a regulated exchange. Move it to a secure wallet if you're holding long-term, and treat it like the speculative, volatile, unforgiving asset that it is. Don't invest money you need. Don't chase hype. Don't trust anyone who speaks in certainties. And remember, the man in San Francisco with the $220 million hard drive, he still has 2 guesses left. He hasn't used them, he's too afraid of being wrong. That's not indecision, that's understanding exactly what's at stake.